Hi, welcome to another episode of the Fundamentals of Accounting and Finance tutorials. In the previous video, we have discussed journal entries related to accounting of equity shares, reissue and forfeiture, etc. In today's video, we will be undertaking detailed discussion regarding the treasury stocks. Treasury stocks are reacquisition of stocks by the issuing company. Let's go into details regarding what are treasury stocks, how treasury stocks are reacquired, if they are cancelled or not, and what happens when treasury stocks are retained by the firm. Treasury stocks are those stocks which has been earlier issued by the firm, and now the firm's management wants to buy back these shares. Once the shares are bought from the open market by the management, they have three options. They can be resold, they can be cancelled altogether, or just they can be held for some time before being resold or cancelled by the company. However, treasury stocks are those reacquired stocks which are not resold and held. So they are neither resold nor cancelled. So that means the firm's management decides to hold on to company's own stocks once they were reacquired by the firm. However, you must note that even if the stocks which are reacquired are not sold, neither they are cancelled but held by the firm's management, they will not be treated as asset. So treasury stock is not an asset. On the other hand, the treasury stock will be treated as a reduction of the overall shareholders' equity portion, and treasury stock therefore will be treated as unissued capital stock. Unissued, authorized but unissued. At the time of reacquisition, the treasury stocks will be purchased from the open market by the management, and generally the method which is accounting methodology which is used for reacquisition is known as cost method. Cost method means whatever amount is paid by the management to buy back the shares from the open market, reacquire the shares from the open market. Under the cost method, the company will debit the treasury stock and credit cash, that is cost of the shares acquired. If these stocks are reissued, the entries will be reversed. Cash account debit to treasury stock if it is reissued at cost. We will go into details of the journal entries in the next segment. In this first example, we will see that MNC Limited has issued 1,100,000 shares of 1 par at a price of 10, which means there is a security premium of 9 per share. On a particular date, the company's retained earnings are $300,000. Now, the firm MNC, this is a typo mistake. The name is written as Pacific. It's MNC. MNC reacquires 100,000 shares which has been issued, it reacquires 10,000 shares at 11 per share. So they are reacquiring 1/10 of the total issued stocks at 11 each. So that means cost of each share reacquired is 11. The journal entry is a simple one, treasury stock debit to cash account. 10,000 stocks are reacquired at 11 each. So the company paid $110,000 in total. Fine. So this means treasury stock being an asset in nature because the share entry, issue entry is being reversed. When the share is issued, generally the share capital is credited. So when the share capital is being bought back, repurchased, treasury stock is debited. And cash is outgoing, because of that cash is credited. So treasury stock to cash. However, the sale of the treasury stock can happen at a later date. If, as I said, the entries will be reversed, if it is reissued at the same price that it is bought for, cash account is debit, treasury stock account is credit. So if the stock is reissued at a price which is equal to its cost, it will be cash account debit to treasury stock. There is no profit, no loss on the reissue of shares if it is sold at the cost for which it is acquired. However, if the selling price of the treasury stock is more than the cost, that means, remember in the previous example, we purchased the stock for 11. So the cost is 11 per share. If it is sold at a higher price, suppose it 12 or 13. So this means the reissue price is higher than the cost, then there will be a credit of paid in capital. The difference between the reissue price, if it is issued for 13 and purchased for 11, 2 rupees of security premium will be going to the paid in capital. And also, if the treasury stock is reissued at a price which is below the cost, the difference will be debited to paid in capital. Let's see the journal entries for all the three types. Reissued at cost. In the previous example, we have seen that MNC Limited reissues the stock at 11, purchased the stock at 11, reissuing at 11. So the reissue is exactly at the same price at cost. The journal entries are very simple. Cash account debit to treasury stock 110,000, 110,000, that is 10,000 shares at the rate of 11. The entry is just reversed. There is no compensating entries, there is no adjustment for capital loss or profit. So the purchase entry was just reversed for reissue at cost. However, if it is reissued at below the cost, purchased at 11, reissued at 9, there is a difference, there is a loss of 2 rupees per share on reissue. Let's see first the journal entry. Treasury was purchased for 110,000, 10,000 into 11. But it is reissued at 10,000 into 9, this should be 90, and as a result there is a loss of 20,000, not 30, this is 20, that's 10,000 into 2. Bought for 11, sold for 9, this is 90, fine, 90,000 is debit. As a result, there is a gap of 20,000 for what it is bought and what it is sold. So that amount is debited to paid in capital from treasury stock. Now let's go to the third portion. If it is reissued at a price which is above cost, purchased at 11, reissued at 13, so there is a difference of 2. The company has been reissuing the stock for 13, whereas it bought for 11. So the entry is mistakes in this should be 1,30,000, 130,000, which is you will receive cash. The company MNC Limited will receive cash 10,000 into 30, but treasury cost is 110 because the company purchased 10,000 stocks at 11 each, whereas it is selling for 13. So this means there is a shortfall of 2 per share. So 2 into 10,000, the entry is credit. So the company is receiving 20,000 for premium. That amount is credited to paid in capital from treasury stock, 110, 20 and 130,000. This is clear. If it is reissued at cost, no entry in difference, the entry is just reversed. But if you are selling at a cost price, only the entry is reversed. If you are selling at a price which is above cost, paid in capital is being credited. And if you are selling at a price which is lower than the cost, paid in capital will be debited. If the shares are not reissued and not held, then the firm and its board of directors may approve retiring or cancelling the shares. They would not like to hold, in this case, these shares. The decision results in cancellation of the treasury stock. As a result, the number of issued stock will go down by 10,000. We have seen in the initial example that the company has issued 100,000 stocks in total. If 10,000 stocks are purchased, reacquired and not resold, then 10,000 will be deducted from the number of issued shares. Now the number of issued stocks will be 90,000 only. So shareholders' equity will go down by 10,000 stocks. So retired treasury shares or cancelled treasury stocks means unissued shares, and it will still remain in the authorized share capital. But the unissued shares stocks, number of unissued stocks will be greater, and issued stocks will go down by the number of stocks which has been reacquired and cancelled. So treasury stock, you must remember that they are not part of the total asset. When it is acquired, this will be subtracted from shareholders' equity. The entire amount of which has been paid for reacquisition will be subtracted and cancelled. If it is reissued, then there will be journal entries which will then increase the number of shares issued. Thanks for the uh, attendance. Hopefully you are seeing these on a later date, and please subscribe to the channel. In case you need more examples, adjustments to the balance sheets, you can WhatsApp me on the above numbers, and kindly subscribe to the channel. That will help me make more videos. Thank you very much. Thanks.